Hey, good morning, Karen. Always great to join you. And it's not for me. I think one of the biggest pushbacks I've been talking to clients about, because there's naturally concerns when you're sitting at all-time highs, valuations might feel a little bit stretched relative to what we might have been used to. I say, look at how the market has evolved and changed over the past 10, 20, 30 years. To me, bringing out a number, an average, a median forward PE multiple that's based on where the market was 10, 20 years ago just doesn't make that much sense because the market itself is very, very different. The economy in the US is very different from where it was even at the start of the global financial crisis. When you think of the market, it used to be heavier in energy, financials, a lot more parts of the value sectors. It's much heavier in growth right now. So to me, I'm perfectly comfortable paying up for growth in the market. I think increasing market breadth is something I'd like to see, but valuations aren't that much of a concern because we're seeing earnings acceleration. We're seeing an inflection with respect to earnings across the broader market. So it gives me hope that we're going to start to see things broaden out. And as long as we're growing into those multiples, I think we should be comfortable paying 19, 20, even 21 times forward earnings for the market.
Matt, I want to pick up on the diversification theme because there was hope that we would stretch out beyond the Magnificent Seven, but even in the Magnificent Seven, we seem to be now sub two of those constituents, a fade on Apple and Tesla at this point. Could it be the very opposite? Could we get more targeted strategies even from here down to just five stocks?
Yeah, whether it's our Super Six, Fantastic Five, I don't know how we want to describe the cohort of companies that are actually driving the market. It has been a narrow market. But Karen, I think one of the issues with the narrowness of the market also just comes back to index construction. The S&P 500 is no longer a good barometer of the average stock. I mean, you have 30% or so of the index that's concentrated in six or seven companies. That is not looking at the market of stocks. When you actually look, when you break down the entire S&P 500 so far this year, over a third of the constituents of the index are actually outperforming the broader index itself. 50% of the index is actually up this year. So you're seeing decent results. You just don't see it at the index level because everything is masked by the heavy weight of the bigger names. And in fact, there's 54 stocks in the S&P 500 that are up over 10% this year, and a lot of them are in healthcare. You even have like a Procter and Gamble and a Walmart that are close to being up 10% this year. So there's decent breadth with respect to the gains. We're just not seeing that at an index construction level, which is why when I talk to clients, I think selectivity is the key going forward. You don't have to own the index, but there's a lot of stocks that you can pick up. You can get diversification and play this broadening theme as earnings continue to beat expectations.